Good morning, folks. Thanks for joining the HOA Desk Community Pod. It's so nice to have you guys, Austin, Ken. I know we've gone back and forth as a lead up to this, and we got in touch because of the changes in condominium lending act that was passed this year, and the article I read on March 23rd. Austin, you were the author of that, and boy, I gotta say, after reading that and communicating those changes to our communities, it's come as a whirlwind here in Dallas. I don't know what's happening across the US, but I know in our little microcosm in Dallas, it's had an impact on our boards and how they're starting to plan for next year. But without me getting into a tangent and going really deep into this, I like to give you both the opportunity to introduce yourselves, give us a little background and how this article came about. And that way we lay the land for our audience. And I'll go ahead and have Ken start us off here.
Good morning, Kim. Thanks for having us. My name is Ken Fierce. I work for the National Association of Realtors. I'm the Director of Conventional Finance and Valuation Policy. So I'm kind of the resident go-to person on all things appraisal, broker price opinion, automated valuations, but also financing. So bank portfolio, Fannie Mae, Freddie Mac, mortgage insurance servicing, all these issues, as well as the government sector.
Thank you, Ken.
My name's Austin Perez. I've been at NAR for going on 18 years now. Ken's actually been here longer, but I do primarily the insurance work. So any sort of questions from Congress, federal agencies, anything related to insurance, that's me.
Well, I'm so glad you say that, Austin, because we're going to be touching on that here on this podcast. Insurance is a big deal. Believe it or not, I haven't had a vacation yet coming out of the holidays and the winter holiday. Now we're going to the summer holidays, but insurance has been just top of mind for our communities and for us. And carriers are starting to get really picky about how they go about who they insure and whatnot. Austin, I'll go ahead and jump in with you, Ken, if that's okay, and just get Austin going on the article that came out regarding the condominium underwriting changes from Fannie Mae. This was an article that I have alerts for NAR as a realtor as well, and this popped up, and I clicked on it, and boy, when I read this, it really resonated because as we're going through transfer documents now for our communities and new homeowners, I started noticing a bit more stringency picking up on the lender side. They're asking for more documentation, a lot of back and forth, really diving into the budgets. Your article kind of painted that picture for me of, oh, that aha moment and light bulb went off in my head. Would you mind letting us know, Austin, how this article came about and what does this really mean to the homeowners, the average homeowners and board members?
Yeah. So, well, I'm glad it was a useful article. So it's a collaborative effort. We have a small team, about 10, 15 people at NER in Washington, D.C. And what we're basically doing is we're keeping an eye on the market and how it relates to sort of government regulations and legislation. So obviously, Fannie Mae, Freddie Mac, anything they do is big news, has big implications for homeowners, condo owners. And I know that the insurance issue has been a particularly sort of hot issue for condos for a number of years now. So, and I mean, I've been sort of following the insurance issue as it's been developing. I mean, this is the latest in what, Ken, I guess this has been going on now for about 10 years, trying to figure out, Freddie trying to figure out how they're going to handle sort of their insurance requirements. But before I get too deep into it, so I mean, the short answer was when Fannie put out when it was announced, FHFA, which is the regulator of Fannie Mae, Freddie Mac, made the announcements that were the subject of our article. Ken and I knew that there would be a lot of questions, so we decided to collaborate and put together that article. And let me actually turn it over to Ken at this point.
Sure. Thanks, Austin. It was, as Austin pointed out, we're always kind of have our ear to the ground for things going on in Washington so we can amplify this out to the industry and all of our members and really drive home why it matters to them. Fannie Mae and Freddie Mac help finance about half of all home purchases. So if you don't qualify for their financing, you've got a problem, right? Or you should say your clients have an issue. Basically, it means half of all buyers wouldn't be able to purchase your property. It means lower demand for your property, reduced values. And frankly, if you don't qualify for Fannie and Freddie financing, it's probably going to be more expensive. So it's a real problem. Everyone in the community should care about it. This is part of a longer term trend, though, or a pattern, I should say, starting with the Great Financial Crisis and coming out of the subprime crisis and going into the Great Recession. Many people walked away from condos, which left HOAs underfunded, created this negative downward spiral where the people who got left holding the bag couldn't afford the special assessments to support the total funding. And so you'd see more people go into foreclosure, more people going into distress. And so what Fannie Mae started doing in 2020 was to start to address some of these issues coming out of the Great Financial Crisis. And what it meant was more documentation. Initially, they started with looking at the type of investors that were in properties, and they wanted to identify, differentiate who are the good investors and bad ones, who would walk away. And they dialed in on condo tells, people who did short-term rentals. Then in the late spring, June of 2021, there was just a horrific incident in Seaside, Florida, where a building collapsed and 98 people were killed. And so this raised the issue of just basic safety as well as finance. And the right reason was, in the wake of it, in the investigation, they realized that this property hadn't been doing their engineering reports. They'd done one just about a month or two prior to the collapse, and they were underfunded by millions of dollars. And what exacerbated the situation was that in Florida, after the Great Recession, because so many HOAs were strapped, the state passed statute that allowed HOAs to waive reserving requirements by voice vote. So it became the norm that most HOAs did not have reserves. So even though now we're talking about in March an increase in reserves, there were many that had none. So they've been under the gun in Florida on the HOA front, but also on the insurance front. So it's kind of a double whammy there. Fast forward to March of this year, and this is the latest iteration, trying to massage these rules, again, enforce safety and soundness, but at the same time, begin to loosen some rules where there isn't risk. So that's kind of, the long view that gets us to date.
Well, I appreciate that, Ken. I was just about to touch on Surfside and what happened in Florida. I think that was in 2021, if I'm not mistaken. And I remember that catastrophe, and I couldn't believe my eyes and my ears from what was being reported on. I think it was all news outlets about what had led to that. It just keeps me thinking, Ken and Austin, this deferred maintenance, right? This just kicking this can down the road. And Ken, you alluded to something, is that a lot of these communities in Florida, at least, and I'm seeing this here in Dallas too, have they don't even have 3 months worth of operating funds, right?
Yeah.
And there was no way. I'm just flabbergasted by the industry and trying to see. We see the impact of the homeowners, right? And we kind of understood what kind of developments, like Surfside, these catastrophic developments led to this tightening. And Austin, I don't know if you have more things to add about what's been leading to this outside of Surfside, but I was always wondering, man, how are future prospective buyers going to know that X or Y HOA is in a really bad state? And we did our part, right, with the transfer documents and the resale certificates to try to fill those forms out and fill those boxes out. But I don't really know if that communicates and conveys the information to prospective buyers, or they even know what to look for when we give them a budget or a declaration. What do you guys think with that? Is there going to be more regulations coming down the pipeline, more tightening the belt, really diving into the books. Is that what you guys are seeing and feeling in DC?
So on the condo front, let me answer two things. First, by starting, uh, the typical buyer is not going to understand these documents, and that's part of what our members do, right? Like that's they are a jack of all trades, deep knowledge in a lot of different areas, maybe not the expert, but they can be that trusted advisor to explain to them what they should and shouldn't be looking for, and so that way they collaborate with the lenders and the HOA management companies in connecting those dots and connecting the consumer with the HOA experts who may be able to explain it a little bit better. On the regulatory front, I would expect this to continue, but at a more muted pace. Even though we saw a number of waves of documentation and changes to what documents were required and template questionnaires for lenders to ask HOAs and HOA management companies. This one, come March, seemed to be a sharpening of the pencil, right? So it wasn't many of prior years were very, very big, kind of a cudgel, if you will. This seems to be a sharpening, and they're getting smarter about the changes they ask for and beginning to relax some of them where they didn't need to be so tight. They're recognizing where some of the rules don't necessarily allay risks and areas where they didn't have rules where they needed some. But also, I think they're going to have to get smart about some of the things they ask. So, in particular, this change in the reserve requirements and and maybe how it's communicated may be difficult for the market to absorb right away. And so
Right.
that they're going to have to reevaluate some of these things.
Thank you, Ken. Yeah, we're definitely seeing the absorption issue, to say the least, here on our side, with board members and homeowners. We have our boots on the ground, manager, associates, managers, and directors having problems in trying to communicate what these mean in real terms, real monetary terms for our communities. And it's always great to have someone like yourself in Austin really shed light into why this is happening and why this is important. Um, and I noticed that, Ken, if you don't mind, Austin, if you don't mind, Austin, do you have anything you want to add to this? Sorry, I put you on mute here. Let me get you out on mute. There we go. Perfect.
Yeah, so I think Ken described it. I would add is that over the last several years, there's been an increase in insurance costs. Actually, on average across the country, you're talking about 2 to 3% increases above inflation. But there are certain pockets around the country, areas where there's more windstorms, there's more hurricanes or floods or risks
Right.
to insurance companies, which means that insurance companies have become a lot more selective if they can't cover their costs, and they can't set their prices. In most states in the country, they have to get approval for their prices a year in advance, and they may not predict everything. They may not be able to raise it to the level that they need in order to cover their costs. And so the only way for them to protect their investment is to, or ensure that they're able to cover all of their contract obligations, is to scale back. So against this backdrop, you have condominiums, which tend to not go to the major carriers, the flows, the jinxes, like the personalities that you know very well among the major insurance companies.
Right.
That's not where the condo market gets their insurance. They tend to get their insurance through surplus lines. These are non-admitted carriers that are going through a foreign-based reinsurance or insurance company like Lloyd's of London. And so, Lloyd's of London can be a lot more selective about the prices and terms that they need to that they can ask for in order to make sure that they're covered. Add to that, I think one other thing besides sort of Surfside, one other thing that was kind of discovered as lenders, and it's not just Fannie Freddie, it's all lenders, as they really started to look and focus on condos and whether the condos were a good risk for their collateral from a collateral perspective. They noticed that a lot of condo associations did not have full replacement cost coverage. Full replacement cost, it just means that if the condo building falls down, is there enough money to rebuild it back to the way it was before? A lot of condo insurance companies, my sense was, did not understand that they had to have full insurance coverage on their condos. So that, I think, led to a lot of people waking up, including property managers, saying, what? I have to have full insurance cost, full insurance coverage for the common areas, including the roofs and the buildings. And I think that sort of set off a lot of questions and issues. And so I think the back and forth, which we're going to get into, that led to the latest announcement, I think that was a piece of this.
Yeah, I appreciate you really painting the picture of the nuances that go into insuring buildings, plural, in communities. And believe it or not, that the process you're describing of the insurance carriers becoming more particular, some carriers issuing a policy and then backing out, 3 weeks into the policy, because I guess they were going to do a separate loss assessment after they were binding a community, right? And we've seen that happen now as well, where it's becoming more difficult over time to get communities insurance. And when we do get them insurance, this year specifically, calendar year 2026, we're in May now, they are requesting in-person walks and inspections now. That's due within a week of binding the policy. And based on that assessment, I don't know if they're using AI. Ken, Austin, I don't know what's happening in the back end, but something is happening where they're really taking those photos that our managers or contractors go out to take and coming back with a piecemeal list of items that need to be addressed before they cancel the policy. And this is a new wave for us, right? I know there was this wave, but it looks like this wave is picking back up again. They're becoming really particular. It's no longer the Wild West that it used to be a couple of years ago. It's now tightening of the belt is what we're experiencing and seeing as well.
Yeah. So I guess maybe it'd be helpful to take a step back a little bit, because I don't think new construction versus sort of existing or resale is that different from an insurance standpoint. I mean, it's really not about insurance. I know that seems to be the most proximate factor that brings the concern or the question, but the insurance is really a proxy for a larger set of issues. And I guess the way I would characterize it is, so insurance is basically, and I mean, I'm boiling this down, it's a lot more complicated, but for our purposes, insurance is just it's a quid pro quo. It's an agreement. It's basically a cash flow tool. It's an agreement. There's a recognition that at times there are going to be acts of God that's going to damage a building. A consumer probably doesn't have the money in a bank account somewhere, in a savings account somewhere, and so they're looking to a market that is willing to indemnify them to cover that large unexpected loss. But here's the quo: in exchange for that, the consumer has to pay for the expected cost of that insurance. Really, when you're looking at the premium, and again, I'm boiling this down, what that premium is two things. First, in the biggest part of the premium is, what does the insurance company expect to pay out over the next year on that property? So it's the loss cost. It's what they expect to pay out. In other words, it's what they expect to pay out in windstorms or a tree falling on the building or whatever. So essentially it's the repair costs of the property is the biggest part of that premium. The rest is just the expenses. You send out adjusters to do, inspectors after the tree falls on the property. What's it going to cost to replace? There's a normal rate of return, the profit margin. But for the most part, what the insurance premium is telling you is what a homeowner or a condo unit owner can expect to pay in repairs on their unit and the broader building over the next year. So if they can't afford their insurance costs, they cannot afford the repairs that are likely or expected according to a risk assessment by the insurance company. So the issue really isn't the insurance price. The issue is whether or not the owner can afford the repairs on the property over the next year. And so I don't think it's actually the insurance cost, it's what the insurance cost is revealing. And I think from a lot of people's standpoints, there are sort of two factors with that. So first of all, it's revealing places around the country where people used to be able to afford to live, but they can no longer afford to live when you factor in the disaster costs. I think the second factor, and this goes to what Ken was talking about, and it really applies to real estate professionals, is there's a surprise. I didn't know before I put down the offer, before I closed on the property, what the true cost of the insurance was for the property. So then there becomes oh my God, like someone moved the goalpost or someone pulled the rug out from under me. And the real estate professional is kind of like trying to answer these questions. And the real estate professional doesn't have any more information than the unit owner. They're not an insurance expert. They're not a disaster risk expert. So I think it's what the insurance cost is revealing. And I think the most important message that I can convey right now, and I agree, Ken said it so beautifully. I mean, our members really should be finding a list of condo experts, and not just condo experts. They should have a short list of insurance agents that they've been working with, not just ones you find on the web. I mean, it should be folks that they can trust. It should also be disaster risk experts who can help provide a risk assessment, who can help say, okay, if you replace this roof or you put in the storm shutters or whatever it is that an insurance company is going to ask for, they need to build out. I like to call it an Angie's List. I mean, I know that that's a sort of a trademark, or I always get it wrong.
We don't talk about that
trademark
stuff here,
or whatever.
Yeah.
So, but the point is,
Austin's
that
list.
Austin's list. There we go.
there you go.
List.
I like that. You need the Austin's list, and it needs to include insurance and disaster risk experts. I mean, don't be the member who gets the question, the real estate professional who gets the question and then tries to answer it. Really connect them with the expert who can answer their question.
Ken, I don't know if you have something to add or tack on there, but I definitely do. For Austin, Austin, you hit the nail on the head, and I appreciate that analogy of how you described what insurance really is and what type of a vessel it is in this market. And that really kind of, it was a different approach and a different way to look at it. So I really appreciate that. And I'm sure the audience will appreciate that explanation as well. But something key you alluded on is, disaster recovery experts or just engineers, and having a relationship with an insurance brokerage or experts or carriers. And that's something, I'm not trying to toot our horn on this call at all, but we've seen what's been happening and how fraught the market has been with not following those fundamentals that you just alluded to and Ken has been speaking of too, is that we have those relationships and it takes years to build those. And it takes folks that understand the buildings and the communities that they're insuring and being able to digest that information for ingestion by a carrier, for example, a foreign-based carrier sitting in London, right, looking at some of these photos or something like that. So, thank you for that color and that explanation. And thank you for emphasizing not just to us in Dallas, but everyone across the country of how important it is to not just go on the web and not do a surface level reach out or protections, quote unquote, right? You really need to dig deep and start finding those experts. We recommend reserve studies every few years. That's a key thing. We always do engineering reports where we have visual inspections and feel like we have to get an engineer and an expert provide an analysis for us to review and for the boards to review, because it's so important to operate at a good baseline, right? And board turnover. This is something that I don't think we alluded to, is that there's a lot of board turnover, right? There's these little microcosms, these little political entities everywhere across the country, right? And it's a hodgepodge of people who this is not their day-to-day profession, right? So it's trying to give them an engineering report so they can read it and review it and ask questions are basically, SEAL Team 6 toolkit for us. Get on the ground and get this stuff out to folks so they know what's happening and what they're up against in terms of their communities. Just a side note here with the current market, right? You guys talked about how it makes folks realize that they can afford to live in certain areas and metro areas based on these costs. We're definitely seeing this is once people really sit down and factor in everything, their own homeowners insurance, right? 8.6, it studs in, and then whatever premiums they have to pay within their dues for the HOA insurances. We see a lot of folks being priced out in Dallas, for example, from condo and HOA ownership. I don't know if you guys have more about that, but that's definitely a cascading impact we're starting to see as people are becoming more educated in buying into an HOA.
So one of the things that's really great about a real estate professional, and I'm not sure most people who are listening to this podcast understand sort of the value of a real estate professional. A realtor is a real estate professional who is a member of the National Association of Realtors. And what stands them out is they subscribe to a code of ethics. And it's basically to put the interests of their clients ahead of their own financial pocketbooks. They're an amazing set of people. When you hire a real estate professional, essentially what they're doing is they are a process and procedural expert. So they know what it takes to go from, the point that you put down the offer, and they can advise you on that, all the way to the point where you actually sit at a closing table and sign all the documents. So they are mostly about making sure that the consumer is avoiding sort of the large procedural landmines. Do they have to talk to a lender for pre-approval? Do they have to get approval? Do they have to have an inspection if that's a contingency? So they are not the folks that you go to if you have a termite problem, or you have water damage, or the electrical box looks something out of weird science. What the real estate professional can do is they have a short list of experts who can help answer the questions. Who do you go to, let's get a couple of master electricians to look at this box. So I guess in that context, another wonderful thing about our members, and I hear it all the time on a wide range of technical issues, not just disaster risk and insurance, but a consumer talks to a real estate professional and they say, okay, here's my price point. This is my budget. This is what I'd like to see in a home. And it's not uncommon for a real estate professional to know that neighborhood, to have sold. Maybe they sold, they helped someone buy, maybe they helped someone sell in a neighborhood, and they immediately realize that the price necessary to close in that neighborhood is not consistent with the price point and the budget that's been put forward. And so the beauty of our members is they gently redirect a consumer to a neighborhood where they can get, most everything they want that they're asking for in a house, but consistent with that price point. So insurance, like areas where you have high disaster cost and high insurance premiums, that, may be a neighborhood that's not within the budget or the stated price point of the consumer. But our members, in many cases, can help them find just as much, if not better, home, just in a slightly different neighborhood that might be a little bit less susceptible to disaster risk and insurance risk. So that I think is an important point.
Yeah.
Absolutely. Sorry, Ken, go ahead. I didn't mean to interrupt.
I was just going to kind of echo what Austin was saying and amplify it other directions that the taxes and insurance, historically, and when we look at the principal, interest, taxes, and insurance, it was always the P and the I that we focused on. More recently, the T and the I have really been outpacing and shocking people. And so that has been an increasing job of our members to amplify that and make sure that people are aware of that and attuned to that. Uh, More so, drawing this back to our discussion, when we talk about these changes at the HOA with the documentation and appropriate reserving, we're beginning to see special assessments creep in, and obviously this is of concern. I alluded to Florida earlier, that they've really been wrestling with this double whammy of the taxes, insurance, as well as special assessments really being ratcheted up because of this proposal come March. And circling back to some of the things we were talking about off the air, Kim, the increase in the reserve requirements from 10 to 15%, that proposal, that's a 50% increase. That's going to put a lot of people over a barrel. Anyone on fixed income, and there are a lot of communities where we have high concentrations of retirees on fixed income. Anybody who's a low and moderate income, like this is an entry level product as well. It's the kind of the barbell of the housing market, the two ends. There are going to be a lot of people strained. So we're concerned about this, and we've been raising this issue with the regulators that this strain is a problem. And you rightly pointed out that in light of the recent dramatic increases in inflation, not just oil, but food and other things, it's all coming together at a very tough moment for consumers. And so that's just something we are reiterating with the regulators that we're working with. Kind of adding to this, unfortunately, the pile on is when it came. It was announced in March, roughly 5 months
Right.
after most HOAs decide for their year, make those
Right.
big decisions about budgeting. So, and then when does it
Right.
have to be implemented? January of 2027, only about 3 months after these same HOAs will be making their decisions for, in October, November for 2026. They're likely not going to have the time to build up those reserves. So we've been impressing upon Fannie Mae and Freddie Mac and FHFA, the regulator, hey, you need to think this through. You're already, this is a big jump for many communities, and it's going to come very fast. So think about spreading it over a much longer period, thinking about doing it piecemeal. Now, there are some silver linings. The FHFA and Fannie did expand their allowances. So properties that had 5 or fewer units and weren't attached to a larger property, they have a waiver from this. They expanded that to
Okay.
properties with 10 or fewer. So that was great. In addition, a property can use their reserve study that takes into account deferred maintenance or any capital improvements that are needed, and use the highest estimate from that to base their estimate of reserve requirements upon. And Fannie will accept that so long, as long as the study meets some standards. So there is a silver lining. They're becoming more flexible, smarter about the rules, but
Right.
obviously it's gonna be a shock to the system, and we're attuned to that, and we've been sharing that and feeding that back to the regulator.
Ken, I think it's so important that you mentioned that as NAR representatives, you guys are going back and basically pressure testing these um, uh, basically changes that are coming down the pipeline. And it's so good to know that there are folks like yourselves out there trying to fight for the common people. So that's really nice to hear. Or just painting a color of, hey, realistically, this might not be so practical, right? It's just not you behind an Excel sheet doing a quick forecast and then pushing it down a pipeline. Let's think about how this will have cascading impact on folks, and how would this basically go to market and how would it really trickle down. We have only a few minutes, and I like to have just touch on two more items in light of all these discussions. I saw in that article that the requirement for investor heavy, or lack of requirement, that's gone away now, right? So can you explain a little bit more as to what that really means and why they came to that conclusion? Because now what I see in my feeble mind is that this will only make it easier for cash ready investors to come into the market.
Yeah, so starting with your conclusion, you're right. It'll make it easier for investors to come in, investors with cash. Why did they put the 50% requirement? So there was a 50% requirement. No more than 50% of the units could be investor owned. Coming out of the great financial crisis, what they found is that, contrary to news reports of jingle mail, or people would mail in the keys, it wasn't homeowners, it was investors. Once they hit that line where things didn't pencil out, or that they started seeing red on the spreadsheets, they just walked away. And created the downward spiral for HOAs and the people left holding the bag, which was home buyers, but also Fannie and Freddie. So they started implementing a number of rules. First of all, looking at short-term rentals, that's much less stable, and started trying to wean those out of the system. And then over time, when you look at these reserving requirements that they got in place, and some of the other requirements and engineering, so that you have a better understanding of the risks that an HOA has, financial risks, and whether they're reserved or not, I think they become more comfortable with having investors there. Now, remember, yes, investors definitely created part of this downward spiral. They kicked it off, but they also were the ones who came back and stabilized a lot of communities. So demonizing them wholesale is problematic, but making sure that they can enter and exit the market in a healthy way that plays well with owner occupants at the same time, the entire ecosystem, I think is what they're striving.
And that's the drilling in deep type of perspective that we appreciate here, and I personally do as well, right? Because I'm sure a lot of homeowners, when they read that article, or they will get to that article or see this podcast, and they'll say, okay, given what the president is saying, for example, or what the administration is communicating to us about institutional investors, how does this really it go in parallel with that or not? So Ken, you explaining it in that sense and giving that backdrop of the great financial crisis is really important, and I really appreciate you for doing that and painting that color. So, gentlemen, this has just been a wonderful conversation, and I'm going to be able to have very happy homeowners and board members go through these and review this video and learn a lot. Before we adjourn, I wanted to just give some time to both of you to explain how you think HOAs should prepare for this, and where in the NAR ecosystem, or what tools and resources does NAR have for the regular homeowner that is trying to weigh, should I go with an AI assisted way of purchasing a home into an HOA or not? What are some resources that NAR would really shine a light on the might of the realtor that's out in the market, that knows the 9 yards, right, of a home buying?
I'll jump in real quick. So in terms of what you can do and what you should do, first of all, from the HOA's perspective, jump on this. It's a little bit of pain up front for a long-term benefit. Remember, getting your property eligible for Fannie Mae and Freddie Mac financing is really critical, not just for you. Even if you're not selling, your neighbor might be, right? So you're expanding the pool of buyers, helping to keep up the value of your properties, right? And it sends a message when these documents are readily available. It sends messages to lenders, to other agents, to to potential buyers, oh, I can get pre-qualified very easily. I can get financing. I can get affordable financing, a lower cost. It's really important. And in terms of the pain, Fannie Mae, and I'd highlight this resource. Fannie Mae has come up with a group within them that actually stores all the documents and basically pre-qualifies a property so that lenders don't individually have to go and submit all these documents and pre-qualify. And so the lenders can see this. They can just look it up on the property when they're pre-qualifying your home buyer. It's called Condo Project Advisor. Each HOA has to designate a person, a point person. They get access to the website. They submit all the documents, whether it's engineering reports, financial reports, safety and soundness reports. They'll have state and local specific kind of issues. Once it's all uploaded and they've reviewed it, they've given you the stamp of approval. All lenders can now see this, right? Even better, they will reach out and let you know when something is expiring or if they need a new document. So again, a lot of pain up front for this great benefit. And then you've got kind of efficiency. You've got these economies of scale, as economists say, that now it's just they're going to come out here and ping you whenever they need something. And it makes it much easier to be part of the process.
Thank you, Ken. I appreciate that. Yes, absolutely. Austin, let me get you off mute. There you go.
So 2 points. So first, don't defer maintenance. So, insurance policy, it's about acts of God. It's not routine things that a homeowner has to do, like replace their roof with some frequency. That, I think, is going to be a big part of any sort of conversation with an insurance carrier is have you been keeping up with your maintenance? So I know it's hard paying the special assessments, but believe me, it will pay off with insurance. I think a second point that I would make, a number of Florida condo communities have been able to get insurance because they spend the money in order to have a professional assessor come out, someone that the insurance company trusts, to walk around, like they'll pull out their drones, maybe it's satellites, but they'll show an insurance carrier that the roof was replaced, a couple of years ago, or, like there's not sort of, torn off shingles somewhere that isn't replaced. So, and I mean, that just like being upfront with the insurance company and telling them what your maintenance schedule is and everything that they ask for, it's important to do that up front. I guess I said two, but let me make it short three.
Sure.
NAR.realtor. This is where the article came from. Let me tell you, Ken and I have spent between us probably about 40 years, I think, between us, Ken, 40 years worth of time developing resources, not just for real estate professionals, but for homeowners. We've got consumer guides, we've got issue briefs and summaries, we've got how-tos and best practices. So please go on NAR.realtor. Ken and I spent a lot of time developing those resources. And hey, if you're looking on our website and there's something that you really need and you don't see it, let Ken or I know. We will develop it for you. We are here to help support the real estate industry and all of its participants, including real estate professionals and clients. And we love what we do, and we are happy to be of service.
Wow. Thank you, Austin. I don't know how to follow up with that, but that was magnificent. And I appreciate you sharing where folks can go get more resources. Thank you for your time. I'm sure, and I can guarantee it, our homeowners, especially going into the summer with the selling season fully ripe, they're going to be really curious and interested into hearing what you both have to say about the real estate market. And with that said, thank you so much for your time. I wish you both a lovely rest of your day, and we'll be in touch, gentlemen. Thank you very much.
Thanks, Cam. Appreciate the opportunity.